You're watching a major currency pair, like the euro against the US dollar. Out of nowhere, it violently surges. No breaking news crossed your feed, no central bankers gave a speech. The economic calendar is empty. If you only watch Forex charts, a move like that feels entirely random. But the catalyst is found in the government bond market. Think of a government bond as a simple national IOU. You lend a country money, and they promise to pay you back with interest. The yield is the effective rate of repair you receive for lending them that cash. A seesaw mechanism represents the core, immutable law of the bond market. Bond prices and bond yields always move in opposite directions. When demand for a country's debt is high, investors bid up the price. Because you pay more upfront, your effective yield drops. If investors aggressively sell off a country's bonds, the exact reverse happens. The price plummets. To convince anyone new to step in and buy that debt, the government has to offer a higher return. The yield rises. This continuous supply and demand dynamic fuels a global river of capital. Trillions of dollars cross borders every day chasing these changing interest rates, and that volume dictates currency values minute by minute. Watching a currency chart means you are only seeing the aftermath of a transaction. To track the money before it arrives, you have to track the bond yields. In normal economic conditions, global capital operates under one simple rule: the ruthless search for the highest available yield. This comparative bar chart shows exactly how competing economies measure up. On the left, a 10-year U.S. Treasury bond offers a 4.5% return. Next to it, a German 10-year bond offers 2.5%. Yield differentials is the term for the 2.0% gap between them. An international investment fund looking to park millions of dollars will take the mathematical advantage. They will actively sell euros and buy US dollars, specifically so they can use those dollars to purchase the higher-yielding American bonds. Multiply that single fund by thousands of institutions globally. That sustained buying pressure makes the US dollar heavier and more valuable, which forces the UR-USD pair into a steep downtrend. Central banks are the architects of these yields. When an institution like the U.S. Federal Reserve hikes domestic interest rates to fight inflation, existing bond yields immediately push higher across the board to stay competitive. Because central bank policy pulls the strings on bond yields, tracking the divergence in monetary policy between two major central banks gives you a highly reliable forecast for long-term currency strength. During the war, a sudden financial crisis, or extreme global uncertainty, the rules of the market completely invert. The psychological motive of the entire global financial system shifts in an instant. Investors stop caring about the return on their capital. They become entirely focused on ensuring the return of their capital. Terrified money floods out of risky assets like stocks and emerging market currencies. Instead, it flies immediately into the safest perceived financial shelters on Earth, which are primarily U.S. government treasuries. Remember our seesaw. This massive panic buying drives U.S. Treasury prices to record highs. Because the prices spike, the effective yields on those bonds plummet. Normally, plummeting yields would make a currency far less attractive to hold, but the world is desperately hoarding U.S. debt to survive the panic, and they have to buy billions of U.S. dollars to acquire it. The sheer, overwhelming demand to hold the currency itself causes the U.S. dollar to surge violently in value, even while its associated bond yields are crashing to the floor. The U.S. dollar follows its yields during stable growth, but follows fear during a crash. Distinguishing between these two modes prevents a trader from misinterpreting a currency surge that occurs while its yields are falling. So how do you actually monitor this invisible war for capital on your own screens? For the euro-dollar pair, you focus on one specific leading indicator: the yield spread between the U.S. 10-year Treasury and the German 10-year bond. This line chart tracks those two national yields over time. If the U.S. yield is rising faster than the German yield, the gap between them, the spread, is widening. Because money flows to the higher rate, this signals a bearish trend for Euro-USD. Conversely, if the German yield starts catching up to the U.S. yield, the spread is narrowing. The mathematical advantage of holding dollars is shrinking, generating a bullish signal for Euro-USD. There is a major trap to avoid here. Financial markets are forward-looking. Bond yields will rise to price in future central bank rate hikes long before the official announcement actually happens. You don't use yields to pinpoint the exact second you click buy or sell. You use this fundamental analysis to establish your directional bias, and then you apply your technical analysis to execute a precise entry. By integrating bond spread analysis into your daily workflow, you stop blindly reacting to lagging price action. You start predicting the actual fundamental flow of global money.